The Dow Jones Industrial Average Index only went up a single point between 1965 and 1981. Yet, the returns for this 16-year period were still around 4.5% per year. Why? Because most of the companies that made up the Dow Jones at the time were paying a dividend. Hello, my name is Maxime Dubé, Portfolio Manager at Claret, and in this video I will explain how stock market returns work and the various ways you can earn money by investing. The increase in the price of an asset. When something rises in value after you buy it, you make money. And most large gains come from an increase in the price or value of an asset. Think of an entrepreneur who starts a business with very little capital but sells it 30 years later for a much larger amount. Just like a business, rising stock and security prices drive returns in a portfolio. These price increases over long periods of time result in returns that are greater than other products that may pay a fixed interest rate. In addition, when an asset is sold for more than you paid for it, it's called a capital gain, and it's the most tax-efficient form of profit in Canada. For those who invest outside of registered accounts, either personally or through a company, only half of your capital gains are taxable. The second most common way to make money with stock is through dividends. A dividend is really just a portion of the profits generated by the company whose shares you own, which is distributed proportionately to each shareholder. The more shares you own, the more you will receive in dividends. Most companies that pay a dividend do so when they believe it's better to return some of the profits to the shareholders rather than keeping them and reinvesting them in the company. This is often the case for mature businesses such as banks, telecommunications, insurance, and energy companies in Canada. While dividends may not be as exciting as the price gains, it can cushion some price loss or supplement the meager price gain in a bear market or sideways market, like the period from 1965 to 1981, during which almost all of the total return came from dividends. The third kind of return is interest income. Interest income is the simplest and most stable form of return in a portfolio. It represents interest received on a GIC or a bond, for example. Depending on the product, this interest can be fixed or variable, and is paid to you at a set frequency. Although the value of these products can fluctuate over time, when you buy a security that pays interest, the majority of the return you expect to earn will come from the interest you receive, not from price fluctuations. Here's a simple example. Say you have a portfolio of $200, you decide to invest half or $100 in a stock that pays a dividend of $2 per year. You invest the remaining $100 in a high-quality corporate bond that pays 6% annual interest. 1 year later, the stock you bought for $100 is worth $110, plus you receive $2 in dividends during the year. Your profit on the stock portion is therefore $112 minus your initial $100 investment, so $12 divided by 100 for a 12% return. What about your bond? The value of your bond has not changed, and you have received $6 during the year. Therefore, your income on the bond investment is $6 divided by 100, so 6%. Overall, your return was $12 from your stock plus $6 from your bond, for a total of $18. Divide that by the total capital invested, $200, and you got yourself a 9% return in total. Not bad at all. There are many ways to build a portfolio that offers healthy returns. For those who are primarily looking for capital growth, over a long period of time, it is the increase in asset prices that will allow the portfolio to grow further and to maintain its purchasing power. Therefore, your portfolio should be more equity-oriented, even for an individual who needs to live off his or her savings. In exchange, you need to be able to tolerate storms when they occur. That said, if you want to minimize sleepless nights and are looking for more stability, a portfolio with a higher proportion in fixed income securities will provide you with a more modest but steady return. For more investment tips, visit our website at claret.ca or get in touch with me by clicking the link in the description. And don't forget to click on the subscribe button below.